Good morning, welcome to Ainsley News. It's Wednesday the 17th of March. Today we're listening very closely to the market. Markets nervously awaiting the outcome of tomorrow's US Fed meeting. Will they be dovish, easing, or hawkish, tightening? Will their view of the economy be bullish or remain cautious? And the golden question, will they start to project raising rates in 2023? Bank of America's fund managers survey inflation expectations are now at an all-time high. Here's this chart here showing inflation expectations. This next chart we're going to show you below from the NASDAQ versus the S&P 500 shows we are sitting on an incredibly important turning point, according to Larry McDonald, noting the world's first and second most liquid and arguably most important stock indices are sending important rotation signals. In our view, both tech and growing equity outperformance run is over, and the rotation is to value and commodity-exposed equities has begun. Here's that chart here, the NASDAQ 100 relative to S&P 500. Is it overvalued? Last time that happened, the S&P 500 didn't peak for over a year afterwards, but the NASDAQ fell over 50%. Eventually, the whole market falls, but the timing is unknown. Does the leverage and all-in now mean a faster overall crash? Frankly, no one knows. What is worth looking at for further guidance is a zoom out to previous full market cycles, not these market or micro cycle distractions we've seen lately. First, let's revisit the oft-repeated cycle psychology playbook. Here's this chart here. Stealth phase, awareness phase, mania phase, and blow-off phase. Real investment advisors spell that out as follows. You can read through this here for the speculative cycle. They then look at the full market cycles. The first chart we're going to show you here shows the real, i.e. inflation-adjusted returns of the S&P 500 since 1871, together with the CAP ratio. Let's take a second and check out this chart in detail. Full market cycles, the real S&P 500 index with recessions. Lots of lovely macro data there. As you can see, it's showing how we may be at a bull market top right now. They then zoom out further and consider a cycle as one of two halves, the bull and the bear super cycles. Again, zoomed out here with that same chart, the real S&P 500 index with recessions. This chart suggests we're only partway through that super cycle and about to head into the bear phase that takes value or earnings back to nil in real terms, as happened in each of the previous two. Applying the market psychology chart above to each of the previous market cycles, and it looks like this. Here's that chart there, and commenting on it, the first full market cycle lasted 63 years from 1871 through to 1934. This period ended with the crash of 1929 and the beginning of the Great Depression. The second full market cycle lasted 45 years from 1935 to 1980. This cycle ended with the demise of the Nifty 50 stocks and the black bear market of 1974. While that crash was not as economically devastating as 1929, it significantly impaired investor psychology. Check out those overlaid graphs there. The current cycle is only 40 years in the making, which is younger than both previous full market cycles. Given markets are trading at the second highest valuation levels in history, corporate and consumers heavily leveraged, with economic growth rates running near historical lows, it's worth considering forward returns over the next decade. Again, showing you that overlaid chart. REA go on to stress that whilst market psychology certainly repeats or rhymes, the actual cause of the bubble bursting is rarely the same, nor what many people may predict, usually because they are applying lessons from previous crashes that shouldn't be repeated. Market researcher Bob Bronson's car crash analogy is a great one. Here it is here. It can be most reasonably assumed that markets are efficient enough that every bubble is significantly different to the previous one. A new bubble will always be different from the previous one. Such is since investors will only bid prices to extreme overvaluation levels if they are sure it's not repeating what led to the previous bubbles. Comparing the current extreme overvaluation to the .com is intellectually silly. I would argue that when comparisons to previous bubbles become most popular It's a reliable timing marker of the top of the current bubble. As an analogy, no matter how thoroughly a fatal car crash is studied, there will still be other fatal car crashes. Such is true even if we avoid all previous accident-causing mistakes. That from him. We can try and figure out what will be the pin for this bubble, be that tomorrow's Fed meeting, or whatever this is, or next week's headline is. But the reality is it doesn't matter. The market will behave like a market has always behaved, and that's just human psychology. The ones who survive are those who don't try to be smarter than the market but balance their wealth for any possibility. Those that thrive in the longer term will weight that balance towards the current signals charts, like we've shown today, that are trying to tell you through all that everything's awesome and don't fight the Fed narrative. That means assets that thrive in such conditions, safe haven, self-inflation hedging, hard assets. Of course, like gold and silver. Well, that's news for today. Thanks for joining us. If you're in southeast Queensland, as we are, enjoy the rain. It seems to be continuing on. Jump over to ainsleyBullion.com.au for all things physical, ainsleywealth.com.au for all things cryptocurrency, and goldsilverstandard.com for our own cryptocurrency built and backed by Ainsley. We'll catch you tomorrow for more news.